So in the latest Bank of England Monetary Policy Committee meeting on the 8th of May 2025, the decision was taken to reduce the base rate of interest. The base rate has been cut from 4.5% to 4.25%. As ever, when I do these updates, I'll take you through a little bit about the thinking behind that cut, talk a bit more about where they think these rates could be going. And there's a wide range, but potentially some quite excessive, quite far-reaching predictions to talk about. And obviously, I'll also talk about how it impacts you right now on your savings and your mortgages. So let's go first of all to that decision. You guys listen and watch these updates that I do every 6 weeks when the Bank of England does meet to discuss the base rate. You already know a little bit about this, but essentially there are 9 people on this Monetary Policy Committee and majority wins. So whoever gets whatever decision gets the most number of people saying they want that, that's what happens. This time, it was a close call in some ways. 5 people out of that 9, so just one that got that majority there, wanted that reduction by 0.25 base points. And that is what happened. The other 4, though, were split again. 2 of them wanted a larger cut. They wanted to decrease to 0.5 percentage points to 4%. And the other 2 wanted to stay where it was. So it just shows you it wasn't kind of, there's a consensus because the majority won, but there's still a lot of opposing views in there for this to happen. But the overarching reason for this cut was the Bank of England say we have seen inflation rates falling as a result of these couple of years now of higher rates being introduced, and then we sort of started to decrease them bit by bit over the last year and so. But that's why they were doing it. They were increasing the base rate at that time because inflation, as we know, went to double digits. It's now at 2.6%. So they're saying, look, this is working. It was getting closer to that 2% target on a more sustainable level. Now, you might know that it did go to 2% not too long ago, a few months ago. It's now back up, and it's expected to increase again by sort of autumn of this year, 2025. It's looking like it'll be around 3.5%. So way above that 2%. It's actually less than the Bank of England thought it was going to be in February. In February, they thought this autumn would be up 3.7%. And that sounds bad. So if it's going back up, why would they be reducing the rate? Surely the whole point was to keep it in there. Well, they say that the inflationary pressures that are going to see them go back up to that level in a few months' time, they're down to certain household bills where the rates have gone up by quite a bit. Water rates, for example, but energy as well. And they expect after that increase, that hike, when we put that into play, it will start coming back down. And in about 18 months or so, it will be back around that 2% level in a more sustainable period. That's what they're thinking right now. So they're thinking that nothing's been done, at least the majority of the people in the Monetary Policy Committee, enough people think we can do this. We can reduce this now for this time. So that's why that has happened. But what does that mean going forward? Huge amount of different sort of forecasts and predictions right now. I was reading some stuff just before the announcement. There were some economists saying that we see 3 or maybe 4 more this year. So we've already had 2 cuts this year, potentially another 3 or 4. Now, bearing in mind there are only 5 more meetings from the Bank of England Monetary Policy Committee in 2025, that would be potentially, assuming there was a 0.25 basis point cut each time, almost every meeting you could see another cut coming. That is quite a lot. That would bring us down to 3.5, maybe even 3.25% as a base rate by the end of the year, which would be quite a lot. I mean, that is a huge change in the predictions from just a few weeks ago, but it's also a massive change to even the most kind of extreme predictions at the start of the year. When somewhat, the outlandish ones, the ones that are kind of outliers, would say maybe 3.75. So this is a sign that in some places they are thinking we are going to see a lot more cuts coming. The Bank of England, though, as well as having their minutes from this meeting, they also had an additional sort of document this time, which outlines a little bit more where they think inflation and the base rate is going to go. Their forecast is more conservative. Now, again, they're basing this on the market rates, and these things are changing all the time. But they are saying that they think in a year we'll be at 3.5%, in 2 years 3.6%, and in 3 years 3.7%. Now, obviously, that's not quite how it always works, but you're looking there. They're saying that we're going to get to a stage in a year's time and the years after that of around that sort of 3.5%, 3.75%, as you'd imagine a kind of a where we are kind of thing. And that potentially could be sort of more a flattish thing. If things stay relatively stable, that's kind of where they think they're going. Now, that is obviously fewer cuts to happen in that time. Now, they're saying a year's time, 3.5%. You could have all those cuts this year. It could be some of them are spread this year and some early next year in these predictions. We don't know. But certainly that chimes with the comment that the change will be gradual and careful. So it's not saying we're definitely going to be doing all these cuts. They're saying they're going to look at everything, all the information, all the data every time a meeting comes along and make a call about whether they're going to make a cut or not. But as you can see already, very, very, very different suggestions. So could we see another 2, maybe 3 cuts this year, bringing us to that 3.75%, 3.5% end of this year? Possibly. Could we see more? Maybe. Could we see yet less? Again, maybe. It's really hard to say. But what it certainly does, even if you sort of go one's more extreme than the other, you certainly does look to us that we are going to be seeing additional cuts this year. And I would imagine 2 or 3 would be a kind of a safe bet to be sort of thinking about right now. Of course, as I mentioned before, these things do change. They always change. The predictions change, not just the coming up, what's happening in the next few weeks, but the next few months, next few years. It's always going to change. And that is even more so right now because of all this uncertainty that we've got from what's happening with these trade tariffs. Now, I'm recording this before the potential US-UK trade deal was announced or released. Potentially maybe framework is what it sounds like. It's more likely there. But even so, anything that happens there for us, hopefully, would be great and help us in how we manage things. But there's a big supply chains across the whole world, which impacts the prices we pay, impacts trade all over. So it's not so clear cut that will sort of sort those things out. And in fact, I watched some of the press conference from the Bank of England as well. And they actually have, and it's in their documents as well, they talk about they've got a few different scenarios in play. So they've based their initial thing on this is what we think is going to happen. But if, let's say, the trade tariffs and trade deals cause problems, that means inflation drops further, then they might want to accelerate the reduction of cuts. But equally, if that doesn't happen, let's say prices go up because of supply chain issues, you could see the other way around and them not wanting to lower the base rate because there's still prices are going up and they want to make sure they try and keep them down as much as they can. So all I can say is there's a wide range of predictions, but certainly I would be looking at least another couple of cuts this year. I say certainly, can never say anything certainly when it comes to base rates, but a couple of cuts potentially coming as soon as June, the next meeting in 6 weeks' time. So that's what's happening. Why does that matter? What does it mean? Well, let's talk about the savings first of all, because this is where you're going to see that immediate impact of this initial cut, and then potentially quite soon those predicted cuts having an impact as well. So easy access rates have been fallen on the whole below 5% for a while now. 1 or 2 have been on it or just above it, particularly when it came to cash ISAs. That's because different providers, digital providers, having a bit of a marketing battle trying to get you as customers offering in and around that 5% rate. With this cut, I think it's likely we'll see most of those disappear on easy access. Maybe we'll see 1 or 2 out there trying again with that marketing spend. But realistically, if every other easy access account has fallen down to sort of 4.5, 4.25, something like that, then they don't need to be offering such an extreme difference. So I would expect us to be seeing those drop down very, very, very soon. Some have already done this. They've already cut their rates in advance of this. Some are actually on tracker rates. So the likes of Chase and Chip, the savings rate you get with those would have fallen already by 0.25 percentage points. So certainly that might be a case there that you can look around for better deals. Probably with Chase, you can do that. Even if you activated, some of you would have got an offer for an extra boost for 6 months to 4.8. Well, that 4.8 is now going to be 4.55. So again, that 4.55 might still be competitive compared to others, might not. You have to have a look. And don't forget, over at becleverwithyourcash.com/savings, myself and the team, we are updating the best buys across all savings twice a day. So you'll be able to see what is going on right now. But you do obviously have to keep that on a pinch of salt, because you might see an account, move your money to it. If they haven't already made a cut, they could do another cut soon and bring you back down. So if you are getting not too far off the top rates right now, and a cut has already happened, maybe hold fire for a little bit and just see what other rates follow suit, because you don't want to move over your money and find then they bring it back down to where you were or lower than where you were before. Certainly if you're getting below 4% though, certainly worth looking around. Just have that at the back of your mind that the rate you move to could drop a little bit now. And of course, that is just on this particular base rate cut. If we do get another one in June, well then could be that drop. Same thing will happen then again. So we're looking at a kind of definitely over this year, those easy access rates falling down, down, down. And if we are saying by the end of this year, something of around 3.75, if not 3.5, if not 3.25%, then the easy access rates are going to be around that rate as well, if not maybe a little bit above it on the whole. Again, there will still be some marketing out there to try and push those rates up. When it comes to fixes, again, they've already factored in a lot of the rates we see right now. We've seen them drop down. The best one-year fixes around 4.5%, similar for 2%. 4.5 on a fix is generally top of the table rate right now. Many of them you hope would have factored in this particular cut, so they might be around for a few more days, but equally they could decide to drop them down again very, very soon afterwards. And that's just on this cut. With fixes, they are looking ahead of time. They're looking at what will be happening in 1 year, 2 year, 3 years, 4 years, 5 years even, and they will price their fixed deals accordingly. And if we are going to see more cuts, faster cuts, deeper cuts, then that will also feed through to those fixes as well. So again, if you want certainty, if you have money that you don't need access to, you are able to lock it away in a fix, then it's well worth getting on that straight away, ASAP, because they will be disappearing. Yes, they're not as good as they were 2 years ago, but they're better than they are going to be in 2 years, in 6 months, in a month, most likely. Again, things can change. That's the problem you get with a fix. If rates do start going up, you're locked in at a lower rate, but 4.5 isn't bad still. Okay, it's not a bad one out there. That's on the normal ones. On ISAs, the rates are already lower there. And again, the same thing will be happening. Remember, we do have, I'll say it again, becleverwithyourcash.com/savings for all the best savings accounts. We also have becleverwithyourcash.com/ISAs for all those individual savings accounts, the best rates for all of those. Now, there are another one I want to talk about here with savings very quickly though. There are some fixed rate accounts known as regular savers. We're talking about these quite a lot. I'm a big fan of these, and these are generally the highest paying ones out there. These ones, sometimes they're fixed, sometimes they're variable. If we are going to be seeing lots of cuts this year, the ones which are fixed, once you get locked in, you've got that, even if it happens, but they can change them before you get them. So here I'm talking about the likes of First Direct, 7% fixed for 12 months. We've got the new one from Virgin Money, 6.5% fixed for 12 months. And we've got the Club Lloyds one, 6.25% fixed for 12 months. Again, you have only certain amounts of money you can put in every single month. We've got more details over on the website. But those ones, there's a good chance at some point, if not now, at some point this year, they will reduce that fixed rate. And I think if you get it and lock it in, it's yours. There are other good regular savers with similar rates, which are variable, and obviously they can change at any time, even if you've got them. So I'm not saying ignore them, but I'm certainly saying I would prioritize the fixed ones so you can definitely get that rate for as long as you possibly can. All those ones do require you to have a current account with those, so you might only be able to get one or two or space out, because when you apply for the current account, if you don't already have it, there will be a credit check. So that's savings. Let's talk about mortgages. I mean, other debts could be impacted, probably less so. You might see some interest rates reduce, but most of the time when you enter into an agreement on loans and stuff, that amount is fixed. And if you're using a credit card, ideally you're not paying any debts on those at all. You might see 0% deals get longer or the fees reduce slightly. So that's good news if you are having to do a 0% purchase or a 0% balance transfer. So that might be on the cards, but broadly speaking, you won't see much change. The one where hopefully, well, people are hoping, I should say, that we will see more change because these cuts are mortgages, because obviously it's likely to be the biggest debt that we've got, and the rates have been, as we all know, very expensive for a good few years now. So what does this rate cut mean for this, and what do those future cuts potentially mean as well? Does it mean that the mortgage rates will be coming down? Well, first of all, remember, if you are on a tracker rate, the same as a tracker rate if it is with savings, that will drop almost immediately as well. So apparently the average mortgage on a tracker rate will come down by £29 a month. Obviously, it depends on the rate you're paying, how much you've got in there. But broadly speaking, £29 a month that will be saved from this cut right now. If you're on a variable rate tariff, an SVR, that one will probably fall as well. There's no guarantee it will happen. No guarantee it will happen straight away. No guarantee it'll be by that 0.25 percentage points either. But they are variable, so hopefully they will come down and save a little bit of money. But they are still going to be amongst the most expensive mortgages out there, even with if this cut is passed on. And of course, if you're currently on a fixed rate mortgage, which most people are, most homeowners with a mortgage are on a fixed rate deal, which ties them in, then there won't be any difference at all because you've already agreed what you're paying. You're locked into that. So really, this cut is really going to affect obviously the tracker mortgages, variable rate mortgages, anyone looking for a new deal. So maybe your fix is coming to the end, maybe you want to get off that variable rate deal. Prices have already factored in this cut. So we've actually seen a bit of a price battle from different mortgage lenders over the last few weeks. And in fact, the best buys for sort of 2 and 5 year fixes are around that kind of 3.85%. So there's most lenders will have something below 4%. Doesn't mean you'll be able to get it because there might be all sorts of conditions, loan to value, other kind of things and fees you have to factor in. But broadly speaking, they're now below 4%, which is great because not too long ago they were above 5%. So we've seen the 2 cuts we've had this year already factored in and bringing things down. But as I say, already factored in over the last few weeks. There could still be some movement based on this cut, but the likelihood of them dropping again because of this cut are quite slim. What we don't know is how the lenders are going to respond to the market rates, the economists and the bank, all these predictions about where that base rate could go throughout the rest of this year over the next few years. Because there was such a wide range of different predictions, and already there were going to be another couple, most people probably would price in a couple anyway, because we could have 2, 3, 4, 5, it's up for those lenders to decide, well, do we reduce rates again in advance because of this? Or do we just wait and see because of all that uncertainty that's come through from the trade tariffs? And of course, even before that was announced, there was already a huge number of uncertainty because of the economy, what's going on here in the UK, how we sort of stimulate growth, the wars in Ukraine and in the Middle East, in Gaza, they are also having an impact on us and oil price and all these kind of things as well. So there's still so much uncertainty. So fingers crossed, we'll start seeing them come down a bit more. I've read a few things today with a few different mortgage experts talking about they could see it sort of by the end of the year still coming down, but we're talking about gradual decreases, not sort of massively. If let's say we did see another 3 base rate cuts this year, it doesn't mean we'd suddenly see mortgages down below 3%. Doesn't mean that will happen. Some of this is already factored in. Okay, so some falling down, but not necessarily as low. And the main thing to remember here is if there are cuts in the coming weeks, in the coming months, coming years, it's unlikely to be back where we were before all this kicked off, before all of this happened. Okay, mortgages are still going to be more than they were. So if you are currently on a 5-year fix coming to the end of that, where you might have had a low deal, it's still going to be more expensive than you initially thought, but hopefully not as expensive as it could have been if you'd been refixing a couple of years ago. The best thing you can do with all this is talk to a mortgage broker and get their views on the different deals out there. And remember, you can also be locking in on some deals up to 6 months in advance. It does depend on who the lender is, how early they let you do this. And you have to check to see whether there are going to be any exit fees, any exit penalties, if you decide you don't want to take that deal before it happens. But certainly, you can lock in a deal right now. And let's say 4 or 5 months' time, rates have come down and there's a better deal that's available to you. If you've got one you can get out of and then go for the other deal, then obviously you will be able to save. But likewise, if things do start going up, because who knows what's going to happen, always can change, at least you've locked in at a rate that hopefully is more affordable to you at the moment. Remember, be clever with your cash.com/savings for all the latest changes. There are going to be so many of them this week and next week. We will keep updating them twice a day, if not more, to keep you informed of the best rates out there. My name's Andy Webb. Thank you so much for watching. Check out these videos here for more ways to make the most of your money.